Neel Kashkari is president of the Federal Reserve Bank of Minneapolis. Before that, he served as an assistant secretary of the Treasury under then Henry Paulson during the Bush administration, and he was one of the key people who helped write the Troubled Asset Relief Program, the legislation which helped steer the country out of the financial crisis of 2008-2009. He oversaw TARP, the Troubled Asset Relief Program, not only during the Bush administration, but also during the Obama administration, at least at the beginning. So when Neel Kashkari takes issue with one of the nation's top bankers, we all have to listen. And he joins us right now. Mr. Kashkari, thank you for joining us.
Thanks for having me. It's great to be here.
So you took issue with Jamie Dimon, who recently in his shareholder letter pointed out, and there were two issues here which raise eyebrows. First, he said that the issue of too big to fail, that essentially is when taxpayers bail out banks, as happened in 2008, that too big to fail is now solved. It's not a problem. And he also said that banks are sufficiently capitalized and that we need to actually lower the capital standards. You took issue with both of these statements. Why?
Well, unfortunately, both of those statements are wrong, demonstrably false, as I put it. The biggest banks are bigger than they were before the crisis. They're absolutely still too big to fail. It's important that the American people know it. We've come up with a plan to increase the capital, that's the buffer that banks have against mistakes, increase that capital requirement. If we do that, we can protect taxpayers. Today, taxpayers are still on the hook, and it's my job to make sure the American people know the facts.
So I want to get right to the capital issues you raised, and then we'll go into the too big to fail issues, because taxpayers wind up footing the bill. You wrote something in your essay which I think all of us would be upset by. You said that the odds of a bailout in the next century are still nearly 70%. When I read that, what I think all of us would interpret is that you expect taxpayers to bail out banks again, perhaps in our lifetime.
That's exactly right. Unfortunately, if you look at the history of our financial system, not just in America, but all around the world, these financial crises tend to happen every few decades, every 50 years, every 80 years, and it ends up being taxpayers on the hook. So we can look at the history of financial crises, look at how well capitalized, how much buffer their financial systems had when those crises happened, and we can actually estimate their likelihood in the future. So the financial system is a little bit safer than it was going into the last crisis, but not nearly safe enough. And if we take these further steps to make the biggest banks safe, we can relax regulations on small banks, and we can have society can be better off. This passes a cost-benefit test for society.
Well, how much do we need to raise capital standards on the biggest banks? Because they're saying they're too high. They need to come down.
They need to be roughly doubled from where they are today to in the 20% range. And think of it this way. I got a mortgage last year, and my bank made me put 20% down when I bought my house. That 20% down that I had to put down is a buffer to protect the bank in case I run into financial trouble. If we make the biggest banks in America also put about 20% down on their investments, that buffer will be there to protect you and me, to protect the taxpayers in case the banks run into trouble. It seems pretty fair, doesn't it?
Well, are the banks healthy enough to raise the standard to, as you said, about 20%?
Well, I think they can raise capital from here, but some of them will likely choose to restructure themselves rather than have to live with these higher capital requirements. So I'm not advocating coming in the government with an iron fist saying break up the banks and we make these decisions. I'm saying give banks the option. If they want to stay so large, that's fine, but they're going to be well capitalized so the taxpayers are protected. If they don't want to have that level of taxpayer protection, then they can restructure themselves so that they're no longer risky to society.
If this were a requirement, it would lead to perhaps the breakup of the biggest banks without the government forcing the breakup. Is that accurate?
I think that's right. There may be certain businesses that have real economies of scale that they would want to maintain their size. Other ones they'll probably spin off. And what we'll end up seeing is a banking system that's much more competitive, with small and mid-sized banks playing a much bigger role, a lot more competition, rather than just having a handful of giant banks dominating the banking industry and putting taxpayers at risk like they are today.
One of the banks that does dominate is JPMorgan Chase, and Jamie Dimon actually said that they have been, because of the regulatory requirements, unable to make the number of loans they would like to make. This is what you wrote, and I'm going to paraphrase, but quote from your essay. Mr. Dimon argues that current capital standards are restraining lending and impairing economic growth, yet he also points out that JPMorgan bought back $26 billion in stock over the past 5 years. If JPMorgan really had demand for additional loans from creditworthy borrowers, why did it turn those customers away and instead choose to buy back its stock? Are you taking a shot at Jamie Dimon there?
Well, I'm pushing back with his own data. On one page, he's boasting about buying back $26 billion of stock. 1 or 2 pages later in his essay, he's saying that capital is holding back lending. You can't have it both ways. If he actually has more demand for loans from good borrowers, he should be making loans. Instead, he's buying back his stock. And so the argument that capital standards today are holding back lending and holding back the economy, it's demonstrably false, as demonstrated by his own words that they're buying back stock today. If we were to lower capital requirements the way he wants, these firms will just buy back more stock. It's not going to lead to more lending.
Do you think that the banks are lending at a sufficient level? Because one of the requirements back in 2008 was that they pass some of the money that taxpayers gave them to borrowers, but that didn't happen quite the way the government expected. Have they gotten to a level that you would deem sufficient?
Well, right now, the economy is growing slowly, and the demand for loans is less than we would like. If Congress passes, for example, pro-growth reforms, whether it's tax reforms or infrastructure investments, and we get the economy growing more quickly, then we would expect to see the demand for loans go up. But until that happens, we're going to expect to see these banks throwing off extra cash, throwing off extra capital, and right now they're buying back their stock. I'd like to see that money go into the economy, make the banks safe and sound, but also have a strong economic growth going forward.
Let's talk about the bondholders, because when I asked you that first question about 70% chance that we would have another bailout perhaps in our lifetimes, bondholders, the people who lend money to banks, expect that you and I as taxpayers will bail them out. Why has that not changed? Jamie Dimon says the issue has been solved. I think most American taxpayers would agree with us that we thought it was solved, but you're saying it's not.
It's not, because this is why 2008, the crisis, was so difficult to arrest. These banks are linked in many different ways, and one big bank in a crisis can bring down another bank and another bank and another bank. And when that's happening, the last thing governments want to do is to impose losses on the bondholders of one of those banks, because it'll terrify bondholders of the next bank who thinks, I might be next. And then they're going to run. They're going to pull whatever funding they can out of that bank, and then the dominoes continue to fall. The only way to stop those dominoes from falling is equity. It's common stock. Yeah. Equity holders are supposed to take losses. They're used to taking losses. They have no ability to pull their money out of a bank. There's no deadline. There's no, when you buy a stock, there's no time in the future when the company's supposed to give you your money back. Unlike a bond comes due in a year or in 10 years. That fundamental difference is what makes equity so powerful in stabilizing the bank and preventing those dominoes from falling. That's the fundamental issue. But
doesn't Mr. Dimon in his letter to shareholders point out that bondholders, in the current way that things are structured, their obligations would revert into stock, and therefore they would absorb the loss in the form of equity? Or is that not correct?
It's wishful thinking. So Fannie and Freddie, long before the financial crisis, Fannie and Freddie had started issuing subordinated debt, and those bondholders were told, if Fannie or Freddie ever get into trouble, you're going to take the losses, and we're going to use your funds to recapitalize Fannie and Freddie. Then 2008 hit. We had this massive crisis, and what happened? Government officials at Treasury, I was there at the time, decided, no, we have to protect those subordinated bondholders because of the risk of contagion to everybody else. So this idea that Jamie Dimon is talking about, other regulators are talking about it, it sounds great right now when markets are calm and the economy is healthy. But in the middle of a crisis, forget it. In the middle of a crisis when the whole country is at stake, those bondholders will more likely get protected, and the taxpayers are going to be on the hook. And that's what I want to make sure the American people understand.
Let me start to wrap up with you because we're running out of time. What is the most important thing that the average taxpayer, that we should understand about what you're saying? Should we be nervous that a crisis is within the next 5 to 10 years in a span that we're talking about?
I'm not worried about a crisis right around the corner. These things tend to take time. We tend to forget the lessons of the past crisis before we repeat the same mistakes. The most important thing the American people need to know is that the biggest banks are still too big to fail today. We need to roughly double their equity capital requirements. And if we do that, we can protect taxpayers, we can make the banks safe, and we can relax regulations on community banks and small banks so that they can grow and serve their communities the way we need them to.
You know, the presidential election that we've just come through, do you think that the anger at the bailing out of the banks and not holding the people the bondholders accountable contributed to how people voted?
I absolutely do. I think it has led to great anger, not just this election, the last 6 or 8 years. I do think it comes from the financial crisis because that crisis was devastating for our economy and deeply unfair. You know, a lot of Americans who were prudent and bought homes they could afford ended up losing their jobs because of the crisis, and then they ended up losing their home. And so the crisis was deeply unfair, and hopefully we'll never have to go through that again. I'm advocating policies I think can help us make sure that that does not happen.
And 2 final questions for you as we wrap up. There are advisors to President Trump who are allegedly telling him that perhaps it's time to do something the Democrats want, which is the reinstatement of GlassSteagall to remove the investment banking portion from some of the commercial banks. Would you support that?
I'm not opposed to it, but it would not solve too big to fail. In the last crisis, you had pure play investment banks like Lehman Brothers and Bear Stearns that were a systemic risk and that were collapsed. You had pure play commercial banks, same thing. It was not simply the merger of these two activities. The most important thing we can do is raise the capital requirements on the biggest banks. If they then want to divide them, that's fine, but we have to start with more capital.
You've been a public servant in the past and given your time and your service to the country. If President Trump were to call you and say, I need you as chairman of the Federal Reserve at some future date, how would you respond?
Well, I don't think anybody should ever say no to the president, but we have an outstanding Federal Reserve chair in Janet Yellen, and I strongly hope that she gets reappointed next year.
But you said nobody should ever say no. You'd be open to the position if she decided she did not want reappointment?
Well, I think there are a number of highly qualified people. And again, you should never say no blanket on any blanket way to the president who's asking for help. But again, I think that Janet Yellen is doing a great job and will make a great chair for a second term.
Neel Kashkari, thank you for joining us.
Thank you for having me.